Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into our latest discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. All right, Dan, I'm going to kick off with you this week because we're recording fresh off US inflation print. It's literally like 141. So you've had 10 minutes to digest the news. So perhaps it's a bit unfair that I'm going to you first. But nonetheless, we had a strong inflation number today, coupled with a relatively, an above consensus NFP print last Friday that also had revisions upwards to past numbers. Are those two things together enough to kind of change your outlook for the Fed? And do you think that this could imply a faster than expected taper?
Yeah, just to address the data first, the inflation number, it is strong, despite the market trading the CPI fixing slightly higher than what the Bloomberg consensus was. It's still at 0.9%. It is a powerful print. And I'm just going over, like you said, it was 10 minutes ago. So I'm just going over the breakdowns versus, what delivered more than what was market expectations. And I gotta say, I mean, it is relatively broad based. Food was high from the headline side. Food was much higher than expected, and even in the core, like rent is sticking higher. The shelter components, they're staying higher. So, but even outside of that, I mean, pretty much all categories were higher than what was envisioned. So it seems like the CPI number is becoming a little bit more broad-based rather than just driven by a couple of categories. Of course, the culprits like new cars, used cars, they're still contributing a decent amount, and they did even more than the generous expectations. But still, it is spilling over. From the job side, again, it was a above consensus number, like you said. It is a very strong number. The revisions were very strong. And those all two point to the Fed moving faster. But I have a caveat here, which is I think we should see more sustainable, a couple of repeating prints instead of jumping and saying, well, we had one strong jobs number, the Fed's going to act because that's kind of like the weak link within their mandate. And now with the CPI number, they might go in December. I think we have another number, well, for jobs and CPI before the next FOMC meeting. So we'll get another chance to reevaluate then. I think the market is justified to react the way it did, sending break-evens higher, sending front-end yields higher, just pricing in a faster Fed reaction function. But I think there's going to be another hurdle right before the December meeting with the same data sets that we got today and last week with jobs and CPI. So I'll be looking forward to them, but I wouldn't say go ahead and fade the market just because it is a very reasonable reaction. The curve flattening the way it is, the market pricing the way it is, and if we get something similar or even slightly weaker next month, I'd say there's a very realistic chance the Fed indicates they might pick up the pace starting next year.
That all makes sense. So I guess sticking with the Fed, last time we spoke was just after the meeting, but until then, Fed speakers had been in the blackout period. So is there anything additional that we've learned from any Fed speakers since they've come out of the blackout period and after last week's meeting?
My main takeaway from this week's speakers was the hawks kind of, talked about like the hawkish views that they had. For example, Bullard saying he has 2 hikes in for next year. We already knew that. But for me, what was a bit of new information was more dovish members like Daly, Kashkari coming out and saying, inflation has been more uncertain than what we expected. It has persisted longer than we expected. They still go with the narrative that it is likely to subdue next year, but still they are acknowledging the uncertainty around inflation. I think confirmations coming from that camp of the FOMC basically kind of guarantees us that it is consensus view within the committee that there's a lot more about inflation that we don't know, and about the outlook about the inflation we don't know.
So I guess rounding off the discussion about the Fed, this week is also, or potentially key in terms of finding out about the chairperson. Can you perhaps run us through your base case view on that. And just for listeners, we're recording this on Wednesday. By the time you listen, we may well know who the next chairperson is. And so I guess perhaps, Jan, within what you say, you could more focus on around how, if at all, we think this may well change the Fed's reaction function.
Yeah, like you said, I can get fact checked on this very quick, even before publication. So my view on that is, at this point, it is widely accepted that the competition is between Brainard and Powell. There were headlines that they both went to the White House separately to be discuss the position of the Fed chairperson with President Biden. So with Powell, we sort of know what we get. And just to start from the beginning, I think Powell remains as the Fed chairman because he's a good continuity candidate. He has been supportive of what Democratic policies were and would have been, I would imagine, throughout the COVID. He's been very, he hasn't been a hawkish Fed chairman whatsoever, I would say. And he's just an easy candidate. And we haven't really heard rumors until now that he would be replaced from the White House. No leaks, nothing that would indicate something's coming. There's like thoughts of pushing him away. On the other hand, Brainard is certainly a more dovish candidate. And there has been some pushback on that view as well. But I think just going over the speeches that she has given recently too, she has been a lot more centered on the full employment mandate. So of course, naturally the market would interpret that as rate hikes have to go for next year. They have to price them out of the curve, because to achieve that full employment within all demographic groups, it's going to take much longer than the next year, even though we might hit like a headline unemployment number that is lower, that is similar to pre-pandemic levels. So if we get Brainard as the next Fed chairperson, then the market would pretty surely take out a lot of the rate hike pricing from the front end of the curve, and assume that we're likely to not see see liftoff next year.
There could still be volatile markets for a few weeks. Yeah. All right, then, Giles, let's talk about the euro area, because, we've talked about this quite a few times on this podcast, the market moves that we've had over the last few weeks. But since the Bank of England last week, we've seen continued flattening of the curve. What's been going on there? Why are long end euro rates or long end German curve close to being negative again?
I think we do know, and I don't think it's been a mystery for the last few weeks what's been going on. It's really just been a question of how long it was going to continue, and that is that people, there were many investors who were, in a sense, positioned traditionally in the right way, trying to express a view that has broadly been validated by data, but which has not really been the obvious sort of way to express that, which is via curve steepeners and being short in fixed income in the long end, looking for higher rates at the long end, has been exceptionally frustrating. And why is that? Well, I suppose if enough people with a relatively short-term perspective, possibly already having suffered during the year, coming to the end of the year, and they're all positioned in a similar way, then there is going to be a significant difficulty when everyone tries to do the same thing and reduce risk at the same time. Obviously, the ECB and continuing to buy lots of bonds, and I guess the end of the year is a little bit less heavy on the supply side anyway. So these are all factors that possible. Well, I would expect are the main the main drivers. Does that mean that we anticipated it? No. Does it mean that we anticipated the whatever it was 10 basis points rally in 30-year Germany yesterday? Absolutely not. I mean, it's coming back. It's correcting a little bit today. I think that that there was a US auction yesterday which didn't go all that well, which maybe opens the question as to whether when there's more liquidity on offer, whether there's that weight of demand really at those points. We'll see again today with the US 30-year, but it's been exceptionally acute in euros, and it's I don't think that we can really say that it's finished, to be honest with you. It may well have been. I do remember in the summer. It's worth just remembering that we had a brutal July, but then things kind of stabilized in August, as maybe it was a sort of bit of a tense equilibrium, but I can also see that we might just enter that kind of a phase for the next 6 weeks. Although, of course, we do have stuff going on. I mean, it's not just a race down towards Thanksgiving and closing down risk. That we do have the ECB in December, for example, and that is a pretty significant event.
Yeah, I guess that nicely brings me on to my next question then. That was a lot about the long end of the curve and what's been going on, but there's been some interesting moves at the front end as well. What's your view of what's happening there?
Right. So, I mean, I think it's just part of the same effect. At the end of the year, there's often excess demand for euro collateral, and there are always a number of possible explanations for that. One of them is, for example, year-end demand for dollars, paradoxically, because what often happens is that that extra demand for dollars eventually gets satisfied via the FX forward markets. It's a bit of a complicated and a bit of a technical situation, but the people who fulfill that demand then need somewhere safe to park the euros that they're lending. I don't think that's it. I think we would have already seen it. It's noticeable to me that that this has really taken off since the beginning of this month, and I think it appears to have gone hand in hand with the stress in the curve overall. So my top hypothesis for that is really it's just people looking for the lowest duration, lowest risk assets in euros, and essentially it's a bid for euro cash, and just somewhere safe to park your money over the next couple of months before doing something with it next year, maybe.
Just thinking back again to the ECB, which you mentioned before, because I guess in Europe, that's the kind of next risk event, which I'm thinking about. I guess similar question to you to what I asked Jan. Do you think that we've learned anything new over the last couple of weeks from ECB speakers? I guess probably this week, the most notable speech was from Schnabel, talking a lot about asset purchases and the kind of sequencing of rate hikes. What's your take on what she said?
Right, so she had a long speech yesterday, actually, that long, I suppose average by her standards, but long nonetheless. But what she was talking about was the sort of the impact of the ECB's policies on equity, I suppose. Equity in the sense, not equity markets, but equity in the sense of are they making the rich get richer? Are they making the poor get poorer? Are they a cause of inequality becoming more acute in Europe and things like that? Okay, so it was a quite wide-ranging speech, but essentially she seemed to, for me, she seemed to accept to a greater degree than perhaps we're used to from policymakers that at least on the wealth side there maybe is a case to answer, and while on the sort of labor income side they've actually been relatively helpful, but the bottom line conclusion really seemed to be a doubling down on this idea that sequencing really is important. They have to stop QE before they start raising rates. And that is something that we've come back to again and again and again in investor discussions, also on this podcast. People who like the flattening theme tend often also to like the idea that maybe the ECB might find a way of raising rates whilst keeping QE going, and that absolutely wasn't the message from Schnabel yesterday. So that was, I guess, the first thing. But the other one was really just a pretty clear focus on trying to reduce asset purchases, and so I think that is. That's going to be the dominant theme for the next few quarters, no doubt at all. And I think, and if I can just conclude by saying, I think that's also just supported by the read from the economic data recently. I mean, we've already been talking quite a lot about the US inflation situation, which seems to be higher inflation for longer. That I think is borne out in most other developed markets as well. And the economic growth data has been okay. I mean, we had a decent survey out from Japan yesterday. The recent surveys from the Euro area have also been pretty strong recently. In the US, they've been all right. So, overall, I don't really see where this sort of policy mistake, panic, stagflation, stuff is all coming from. It doesn't seem to be tracking that way. It seems much more traditional reflation, and I think that does eventually mean higher rates, steeper curves. But with we've already been over all the caveats at the start of my comment.
I guess that's probably one thing that sets Europe apart from, other regions, is that this kind of stronger fundamentals means that it's all about tapering rather than rate hikes in Europe, and hopefully, like you say, that brings about steeper curves. All right then, Theo, over to you. Although I'm very excited not to be talking about the Bank of England this week, because it feels like we've been talking about them every week for the last, I don't know how many weeks. So let's talk about something a little bit different today and think about UK issuance. There's a syndication coming up in 2 weeks' time. So can you give us your thoughts on that kind of issuance event?
So our expectation is that on the 23rd of November, the DMO will launch for around $1 billion cash. That's called it around 1 billion nominal, around 4 billion cash. Will issue a new linker that's going to be an ultra long bond. So this bond, the maturity of the bond has been decided as of March 2073. It is a topic that we discussed earlier in the year in August, and we've published a piece where we looked at valuations. So this is very exciting because the DMO, they're responding to investor demand, and there is investor demand for inflation-linked paper. It's another story whether the demand is for ultra longs. It's a separate topic, but there is definitely demand for inflation-linked paper. So I think it is something quite significant from a duration point of view. About 60% of the duration that you get in a quarter, you may get it just from from one bond. So it is a pretty big deal. And it is a big deal both for linkers, but also for the conventional market. So this goes very well with the story that Giles mentioned before, which is the flattening of curves. And what we've seen in the UK is also a relentless flattening of curves. But there is a reason for it. And the reason is really the lack of DV1. So we had obviously, after the remit, a cut in long gilts. And then also, we're not getting that much linkers, even with an ultra long. So if investors need to get duration, well, they will flatten the curves. And this is what has been happening. So we think that this is a significant event. It's definitely something that we keep a close eye on. And, it will be the biggest linker on the curve. And it will be, to the best of my knowledge, also the biggest linker across developed markets. So it's going to be the longest, in terms of maturity, it will be the longest DM linker.
So how does this change your view then, I guess, of long end linkers? We've seen break-evens kind of narrow over the last couple of trading sessions, and now we're going to get this big duration event. Does that change what you think about the direction of travel of long end break-evens?
I think the one point that we need to make is that in terms of issuance composition, the DMO chose to cut issuance from longs and allow some linker issuance. And that had implication for break-evens. There are other regions that had also implications for break-even, but that has been quite significant. And this is why we've seen the break-even narrowing. And we've seen a significant positioning into break-evens. And we've had a view, and we've been supportive of wider break-evens. This is something where we're getting, some headwind. But to be fair, what we also see is that we are reaching levels where break-evens, specifically linkers, they look attractive. They look attractive from a long-term valuation point of view. They look attractive versus inflation derivatives. They look attractive in many ways. And also, even during days that you would expect break-evens to be weak, break-evens are actually not so weak. So we maintain the same view. We like long-end break-evens, and we think that this is a theme that we definitely want to run into the syndication.
What about your views in nominals then? Because you've had this call for the last couple of weeks for gilts to outperform bonds and treasuries on the fly. Do you still like that? Is it still a trade that we're in?
So there's been two catalyst moments for the trade. One is the remit and the significant retexture with regards to gilts. The other one was the BOE call. And I know that we promised not to talk about the BOE, but it is still relevant. This is why we need to bring it up. So those 2 points and the non-reinvestment, or to be fair, the non-reinvestment theory about that bond in March that is getting challenged, i.e. the reinvestment of that maturing bond, that is supportive for gilts. Now, in the very few sessions, there's been, yes, some selling of gilts. And I mean, it is a view that moved by 40 basis points. Yes, okay. As of now, it is up by 30 basis points. Do we still like it? Absolutely. Because we think that the story of low net DV1 in the UK can still play out, i.e. we will have days when there may be some cheapening of gilts, but we think that with a bit of buying, the scarcity of paper can get the asset class to squeeze and become a lot richer quite faster. So we do like these dynamics. We think that the market still believes that it will get a lot of DV1 from the linker syndication, which it will be a big number. It's going to be between 20 and 25 million a basis point. It is a big number. We don't challenge that. However, after that, and when we look at the December schedule or early next year, the DVR profile looks particularly low, in which case we think that gilts will have a great opportunity to shine, especially versus other fixed income assets.
That makes sense. All right, thank you, Theo. I think that's probably all we've got time for today. So thank you everyone for joining me. And I just wanted to remind our listeners that if you like today's episode, please hit the like button and don't forget to subscribe so you can listen to our latest episodes as soon as they're available. Thanks everyone. Speak next week.